So as we already said, the value of a business is really separate from its real estate. And today's conversation is really going to be a high level, as I mentioned, and it's going to be kind of a 101, 201. We're not going to go super deep, but we're going to get deep enough to help you understand where exactly it's at. So let's continue here and figure out what the value is not. First, the value of a business is not the investment in the business. So you might have spent 50, 100, 200, 500,000 or more to start the business. That's not what the business is worth. It's also not worth what you need to retire or what amount you need to put your kids through college or what amount you need to pay off your bills. I remember a senior business broker telling me years ago, what if you walked into a bagel shop and that bagel shop was selling $10 bagels? And the business owner said, and you said to the business owner, why are your bagels so expensive? What makes them so unique? And he goes, nothing. That's what I need to pay off my medical expenses. $10 a bagel. You would go find another bagel unless you're really, really, really hungry and there's no other bagels in town. Well, the truth is, doesn't matter to buyers how much you need from your business. It's going to be what the market dictates. And in our world, it used to be the world of the business broker. We would have a book, and we'd take that book and we'd shop it around town. And that's how we would find buyers. We would go talk to different business owners. We'd have a big network, and we'd talk and we'd gather. There was no internet 20 years ago. Well, now with the internet, all our buyers do is with a few keystrokes, they're on hundreds of websites where people are selling businesses. They can figure out the value of a business in about a day's worth of research. It doesn't take much. They can quickly realize most businesses that are listed around this price, that one's listed significantly higher, that one's too expensive, that one's overpriced. It's very easy for today's buyers to see the value of a business very quickly. And so it's important that we understand value and pricing is a function of the marketplace. The marketplace dictates what people are going to be willing to pay for things. Now, years ago, we used to have a saying, we used to say it was better to have a dumb buyer than a good listing. Today, I don't think there are any dumb buyers, or at least the number of them is certainly reduced. Today's buyers are more educated. They're more savvy. They're looking on the internet. There's tons of resources just at their fingertips. They don't even have to leave their office to find information on what a business is worth. But here's the sad part. My sellers, they don't have any idea. They're not out there looking at hundreds of websites. They're not analyzing businesses. They're not trolling all of these places and seeing what the competition is doing. All they know is their business. So oftentimes the value is hyperinflated because they don't have anything to compare it to. So one more thing I want to talk about is the value of a business is not the cost to buy the franchise. This is similar to point number one about the investment. Oftentimes we'll have franchises that it costs $30,000, $50,000, $300,000 for the cost of the franchise plus build out. Remember, it's not the investment into the business that is the value, because the way it works is a buyer is going to look at any business and compare it to all the other businesses. So let's look specifically at franchises for just a moment. New franchise versus an existing. When someone buys a new franchise, it's based on cost, not value. Cost of what is the franchisor charging for the fee, cost of what is the build out, cost of what do I have to pay for the furniture, fixtures, and equipment, cost of inventory. That's what a new franchise is based on. But an existing franchise, the way those are typically valued is based on profit, not cost. In fact, I'll tell you a story. I had the number one franchise of an entire chain of restaurants throughout the Southeast. Number one, 20 different stores. This was number one. It was 10 years old, top producing. The franchise itself, buy-in or cost, was $675,000. We tried. We were certain that somehow, some way, the number one of the entire franchise should be worth more than a brand new startup. The marketplace over a year and a half told us it wasn't. It sold for significantly less than the cost to build a new. Difference in cost versus value. The buyers told us it was worth a multiple of its net profit. It was not worth the build-out cost. So this is something you want to take a look at when you're getting ready to sell your business. Now, one of the exceptions that we do want to keep in mind is different buyers have different value basis. And so what I mean by that is a financial buyer who's going through the internet and looking at all the different types of businesses, He's going to look at, I have X amount of money. Let's say it's $200,000 to spend. What can I buy for $200,000? And the what can I buy is the net profit. So if I have $200,000 to spend and this company gives me $100,000, but this company will give me $120,000, well, I'd rather exchange $200,000 for $120,000 a year versus $100,000 a year, assuming the businesses are very similar. So businesses are often valued from a financial buyer's perspective based on the net profit. That is their key component. In a franchise, somebody who understands a cost basis, who is used to looking at the cost of building a new one, well, they have a different value basis. So therefore, they may be willing to pay you more based on cost than on value. And sometimes we find that even within industries. Some industries will allow where a buyer buys in based on a cost value, not a cost basis, not a value basis. So we want to be careful there. Again, financial buyers, they're taking a chunk of money and exchanging it for a yearly income. That's what a financial buyer is looking for. Now, many times there's specialty skills involved, and sometimes there's licensing. So there's other factors there as well. It's not as cut and dry as I'm making it sound, but certainly I want to make sure that you understand the concept. So let's now look at the various ways to value a business. I'm really going to talk today about 3. There's many, many more. There's about 22 different methods. And if we got one of our appraisers on the line, he could get way deep with each of us on this, and so deep that we'd all have our heads spinning by the end. But I want you to understand the main ways that buyers are going to value your business. So we're going to look at 3 different methodologies. And these are the most common. The first is a multiple. It could be a multiple of sales. It could be a multiple of profit, which is also called earnings or EBITDA, but it's a multiple of sales or earnings and EBITDA. The second one is the value of the hard assets. That's fair market value or liquidation value, and we'll talk about that. And then the last one is the value to the buyer. And this is more for a strategic buyer, and we'll talk about unicorns and how those happen as well. So let's talk about starting with understanding multiples. And multiples are, first, we got to apply the multiple to something. And that something needs to be normalized. So when you're preparing your financials, your P&Ls, and your balance sheets, what you're doing as a business owner, in many cases, is you're trying to minimize your profit because you don't want to pay taxes on it, of course. So what happens is we tend to put things in there that reduce our tax liability. So things that are perfectly legitimate write-offs. If we had a cost of a lawsuit, we put that in there. If we had a major repair, we put that in there. Sometimes personal benefits slide in there, like vacation homes or personal trips or non-working family members or maybe your groceries. Those are all things that end up in the financials, but the truth is a one-time expense is not a reoccurring event, so it's not something the buyer would expect. So we want to normalize those numbers. We call that process recasting. And when we recast, we add back anything that's a one-time expense. Could be, as I mentioned, a lawsuit or major repair. We add back any personal benefits that can be proven, vacation homes, personal trips, cars, anything that's personal in nature. Again, we don't go crazy on this. You want to show clean books and records to a new buyer. But also, we normalize the balance sheet. So what would the working capital be if you're a larger business? What would your inventory requirements be? We make sure that everything is where a buyer would expect it to be. And once we do that, then we start applying multiples. But there's no point in applying a multiple to a number that doesn't make any sense. So let's talk a little bit about earnings or profits, because there's some language discrepancy here that often occurs. In small business deals, we often talk about what's called SDE, that's seller's discretionary earnings. In bid deals, everything over $1 million of earnings, we talk EBITDA. That's earnings before interest, taxes, depreciation, and amortization. So all EBITDA is your net profit with the interest, taxes, depreciation, and amortization added back. Seller's discretionary earnings is EBITDA plus the owner's salary. And let me explain why we do this. Let's say that you've got a business that does $1 million in sales. Let's say you do $200,000 net profit, but you've got owner's salary, $200,000 of EBITDA, but you have owner's salary of another $150,000. Well, in a small deal, that $150,000 of 200 is a big deal. That's a lot of money. That's almost 75% or. So we want to make sure to add that in. In a big deal, let's say you've got $1 million of EBITDA. That 150,000 is relatively small now. It doesn't make as big a difference. So when we talk about small deals, we talk about sellers' discretionary earnings. When we talk about larger deals, $1 million or plus in EBITDA, we talk EBITDA. So let's talk a little bit about the multiples, because sometimes people confuse these multiples. So when we look at earnings, so anything, and again, earnings is another word for profit. Earnings is not another word for revenue. I often see it confused. There will be articles saying a business sold for 6 times earnings, and people think that's 6 times revenue. That's not true. Earnings is profit, not revenue. So we want to make sure to keep our language very, very specific here. So if we're talking $1 million, less than $1 million of EBITDA, we're talking a 1 to 3 multiple of SDE. So that's 1 to 3 times. The way that stands out is a buyer looks at a business and says, how risky is it? A business that's a one-man show, let's say an appliance repair company. Appliance repair company, one-man show, all he does is repair appliances. It's a job. You're buying a job. All you're really getting is a phone number, maybe a website. There's nothing else, no other infrastructure really there. That's going to be a 1 multiple, or very close to a 1 multiple. Whereas a restaurant with a retail outlet, they've got servers, they've got equipment, they've got people walking in, they got some stuff, that's going to be a 2 multiple. Manufacturing plant, that's going to be a 3 multiple. They've got even more stuff. They've got long-term contracts. They've got more of a global reach versus just a local service. So the less risk a business has, the higher the multiple they get. So typically we're going to see a 1 to 3 multiple on small businesses. Now there are rare exceptions, and you see down below, technology industry. That blows all of these numbers out. When you start getting businesses that have reoccurring revenue that keeps coming in, like e-commerce businesses, like insurance industry, sometimes CPA practices where they have bookkeeping, that skews these numbers. And many of these businesses I'm mentioning down below are multiples of revenue, not of earnings. So it's important that we do keep that in mind. And again, it's a very rare sector. Most businesses, 90% plus, are going to be valued on earnings, not on revenue. So once you go from $1 million to $5 million of EBITDA, now you're at 4 to 6 times EBITDA as the multiple. Over $5 million of EBITDA, you go 7 to 10 times EBITDA. So when you start looking at these, you can see the smaller businesses get a 1 to 3 times SDE, which is bigger than EBITDA, but the bigger businesses get 4 to 6 times EBITDA. What we found is those 2 numbers end up being very, very similar. You can either go 4 to 6 times EBITDA or 1 to 3 times SDE. We choose to use 1 to 3 times SDE as the multiples that we use, and that's what our comparables have shown us. We don't base things on EBITDA. The businesses are usually just too small. So if we continue to look at multiples, we achieve that multiple by going through a comparable sold business, so like business type. And the truth is, no 2 businesses are ever exactly the same. So we can't compare apples to apples. It's just not physically possible. So we have to kind of look at what's like this business, what's similar in nature. And of course, most of these multiples are going to be based on the profit or the earnings, and very few of them are based on the sales or the revenue. We already talked about CPA practices, insurance, some things that are commission-based. They'll go based on sales. And here's why I want you to take a look at why we base things on profit. So you had 2 companies, both landscaping companies, both husband and wife owned. In company ABC, the husband and the wife are the main operators. They typically do sales under $250,000. Their profit is $100,000. They burn out in 7 to 10 years. The value of this would be somewhere around $200,000. They get somewhere around 2 multiple. But you can see XYZ company has built it up. They were at the same 250 years ago and continue to grow and grow and grow. And now sales are over $1 million. And so they were able to take it and give it a profit of $350, and now the value is over $750. Again, same multiple, but different strategies. So you want to take a look at how you're building your business. But imagine this: if you had both companies, say one company was $250,000 of revenue, one was $1 million, but they both had $100,000 net. Would you want to pay for the one that has higher conversion of profit or lower conversion of profit? They both would be valued about the same. So it's important that you look at your business from the eyes of a buyer and see, what does a buyer buying? What would they want? And so that's just an example of understanding how the multiples will work. The next valuation method is the value of the hard asset. And oftentimes this is used in failing restaurants or failing businesses. This is where a business has high furniture, fixtures, and equipment value and high inventory with low profits, relatively low profits. So oftentimes what will happen here is the buyer, all they're really buying is the hard assets, the stuff. And there's two ways to value the stuff. One is a fair market value, which is basically what would it cost to replace all the stuff. Inventory is always at cost. Furniture, fixtures, and equipment goes at fair market. And that's really the price. I have a business right now that it does $100,000 in profit. It's a 2 multiple. It gives me $200,000, but it has $370,000 of stuff. And so we priced it at $370, but I will tell you it's a very difficult sell. Buyers want to buy cash flow. They don't want to buy hard assets. If they were going to buy hard assets, they'd go do a startup. They don't want that. They want to buy a proven cash machine. That's what our buyers are really looking for. So when we talk about that, the value to the buyer, the value to financial buyers is your cash flow. How much cash are you converting? This is why right now we're at the beginning of the year. You've got an opportunity to clean up your taxes. If you have anything in there that is reducing your tax burden, that may be more personal in nature, that maybe shouldn't be in the books to begin with, this is a great time to get those out of there. Keep your business clean. You want to have 3 years of clean tax returns to show a buyer. And the sooner you start on that, the sooner you're going to get a higher value of your business. Now, some people often say to me, but Kim, what about these businesses like Instagram, who sold to Facebook? Kevin Systrom and Mike Krager, they sold their 13-person startup. Instagram, this little itty bitty company, 13 people. 18 months is all they were alive. That's all the business had of longevity, and it sold for $1 billion. That's what I want to do. I got to be honest with that. There's these things, we call them unicorns. They're very elusive. They don't happen that often. They're very rare. They're once in a lifetime. Instagram sale was a unicorn. And unless you're going to live in Silicon Valley, and unless you're going to have a name like these guys, and unless you're going to create something that, wow, most businesses are not going to be unicorns. They're not going to get those multiples. They're not going to be there. That's not normal. That's the unicorn. So I want to make sure you know that. I don't want false expectations, because too many times people think, well, if Instagram did it, I'm the next Instagram. Truth is, you're probably not. And so I would rather be more realistic, and let's be surprised if Facebook comes by and offers you $1 billion. Well, let's cheer. So let's assume they're not, and deal with a more realistic approach to what the business is probably going to be worth. So let's talk about these strategic buyers, because they definitely are out there. And for some industries, they're much more prevalent than others. For example, property management industry, that is one where we constantly see strategic buyers popping up. Insurance industry, we see it there as well. These buyers will often pay more. We also see it in franchises. Oftentimes, if someone has a highly desirable territory, somebody else wants it, and they're going to pay more than your financial buyer. Most commonly, we see these once we get over $1 million of EBITDA. So if your business is not going to be $1 million of EBITDA or greater, then a strategic buyer may not be your best buyer. Your best buyer may very well be a financial buyer, which is why I spend so much time on the financial section. So these buyers are looking for very specific benefits that are unique to the buyer. So when you're looking to sell to a strategic buyer, you've got to think about, who's my buyer? What do they want, and why will they pay me more? Just because you do the same thing they do doesn't mean they're a strategic buyer. They may be just an acquisition, and it may be a financial buyer looking to add revenue, add profit and revenue to their top lines and bottom lines. So you've got to think about what is so unique, so different, so rare that they're going to be willing to pay you more. Because if you don't have anything that is so unique, so rare, so specific, they're probably not going to pay you more. And then we're going to go back to fair market, and then we're going to go back to financial buyers. Again, remember, it's better to base your analysis on a financial buyer, believing they're going to pay you on profit, versus erroneously planning for strategic buyer. And then be surprised if you get the strategic buyer. Be surprised if they give you more. But be realistic in your approach so that you can have realistic goals and numbers, and not be frustrated when you find out that a financial buyer is most likely your buyer. And remember, not all businesses are eligible for strategic buyers. Restaurants is a really good good one. Restaurant buyers tend to be buyers that want failing restaurants. They don't want to buy successful ones. And really most restaurants, unless they've got an incredible location, which very rarely happens, most buyers are going to be looking for the financials. They're going to be looking for furniture, fixtures, and equipment value. So keep that in mind as you're building your business and looking at how can I build it bigger and how can I add value. Strategic buyers can be there. And again, the larger the company gets, once you get close to that $1 million of EBITDA or earnings, now we're starting to talk possibly a little bit more on strategic buyers. But many times we're still in the financial buyers, even at that level. So how do you add value? We're going to touch on that briefly here. One is you got to know your buyer. And for most of our businesses, they're going to be under $1 million EBITDA. They're going to be a financial buyer. So they're going to do a multiple of profit. So that means, how do we get our profits up? The first thing, we talked about this briefly, is you got to clean up the book. Get any unnecessary expenses off of there. But equally important is make sure that you put all of your profits and all of your sales on there. Too many times I find cash doesn't make it to the P&L. And it's important that that cash does make it to the P&L if you want the multiple applied to it. Now, if you don't want the multiple applied to it, then you've already been paid for the value. But if you do want the multiple applied for it, then you certainly want to be cleaning up your books. Now, I say this is true especially under 300,000 EBITDA. And the reason that's true is because those businesses are typically going to be going through some level of financing or some level of a financial buyer. So you want the books to be as clean as possible. You want to make sure that these are going to pass scrutiny of a less sophisticated buyer. Once you get over 300, 400, 500,000 EBITDA, you've got a more sophisticated buyer. They'll tolerate more. But your less sophisticated buyer isn't going to tolerate as much adjustment. You want to make sure you have clean books. Second is you want to be focused on growing profits, not just revenue. It'd be great if you could grow revenue by 70%, but it would be horrible if your profits stayed the same. So you want to focus on not just revenue growth, but profit growth as well. And then last, you want to reduce risk. You want to look at your business and see what risk would a new buyer have. Do I have too many personal relationships that I'm relying on? Do I do too many jobs? Do I have contracts that won't transfer? Do I have assignment clauses in my contracts? Do I have the ability to transfer these relationships? What about my key employees? Are they going to stay if I leave? Is it my mom, my dad, my sister, and my two kids working at the business, and they're all going to leave when I leave? So these are the things that you really want to be thinking about as you're going through valuing your business. Now, as I mentioned earlier, we're going to be doing this webinar series monthly. And so every month we're going to talk about how to add value. So this month is really understanding what the value of the business is so you can point in the right direction. So every month we're going to pull various experts from different sectors, and we're going to go through what that value is. Registration is going to be at sellyourbusinessformillions.com. That'll be officially up February 1st, and we will start with registrations there. It'll be the third Thursday of the month, always at noon, and we're going to keep them to about 30 minutes or less. And these webinars will be recorded and will be sent out to everybody who registers. So I understand some people can't do a noon meeting. Certainly that's understandable. I know we've got a lot of busy people, but I will send the webinars out. I will make those available. All of this is going to be at no cost. My goal and my job is to help every single one of our business owners in the greater Northeast Florida market drastically increase your business over the next 12 months. We've got a booming economy. We've got major tax breaks that were just announced. This is an incredible time. We just got to aim at the right target. So I'm going to provide that target and that guidance for each and every one of you. From being on this webinar today, at the end of the webinar, I'm going to go ahead and email out the checklist of how to add value. This is a 3-year plan to adding value to your business, and it'll go through all the major areas you want to look at. I'm also going to go ahead and provide a video of today's webinar as well, so that you can go ahead and review that at your leisure. So next month's webinar is going to be the third Thursday. It's going to be February 15th. And we're going to be talking about how to leverage processes to add value. And I've got a very talented automation engineer, and she puts the processes in companies, small companies and big companies, and really shows them how to leverage technology to be able to take their business to the next level. You're not going to want to miss this. She does a tremendous job, and we'll have her again Thursday the 15th of February at noon. So as we get ready to wrap up, I've left a few minutes here for questions. I'm going to go ahead and unmute everybody. if you'd like to go ahead and ask questions at this point, I'm more than happy to stick around for the next couple of minutes and answer any questions from anybody who may have any.
Kim, the thing for just clarity, when you talk about profits, would you clarify if we're talking gross profits before expenses? Are we talking profits before taxes? Are we talking net profits? So that word gets thrown around a lot and it's hard to understand.
Yeah, absolutely. Absolutely. So when I talk profits, and let me define the words you're using so that we make sure we're using the same words. Gross profit is revenues minus cost of goods or cost of sales is gross profit. That's typically how we'll use it. Then gross profits minus expenses creates net profits for us. So when we're talking expenses, we're talking raw net profits. So unadjusted net profits, and then we recast those to get the adjusted net. Does that clarify your question?
Thank you.
Okay. Any other questions? Well, I thank everybody for joining me today. Again, I'll be sending this email out here shortly with an attachment to the webinar as well as the checklist. If you certainly have any questions in the meantime, you can always check out our website at sellyourbusinessflorida.com. Certainly call me at any time. The number is 904-571-9580. Everyone have a great and blessed day, and here's to the amazing start of 2018. Have a great afternoon, everyone. Bye-bye.